What is up, everybody? Welcome back to another episode of Bitcoin and Markets. My name is Ansel Lindner, and today I wanted to go through a few videos of people that I respect in the space in macro and what they're saying about this Powell pivot, because I don't agree with a lot of what people are saying. And we're also going to listen exactly to what Powell says so we can interpret what these pundits are telling us. First off, let's share the screen and go to bitcoinandmarkets.com. Is that showing? There we go. bitcoinandmarkets.com. That's where I put all of my stuff. You can see the latest is the fundamentals report that comes out every Monday. We live stream after that to discuss that. And I do a professional tier newsletter as well. See, this last one is It's All Noise Around the Recession Signal. Go deep into that. I do put out some podcast versions of these live streams, not as many as anymore as I would like to. We also have a monthly price forecast competition for paid members. So if you join for $5 a month, you can put in a guess at the beginning of the month for what the price will be at the close of that monthly candle. And the closest person gets $20 in sats. Also want to go jump over here to bmpro.substack.com. I'm writing for them now. I do 3 posts a week, one major big post here. And then I do a bunch of dashboards. So a market dashboard and a mining dashboard once a week. And this is my latest for them. Bitcoin miner stocks primed for rally, plus Bitcoin price update. And I go through all sorts of charts and talk through everything. Pretty good value. Plus, there's other people that post on this thread as well. So check out bmpro.substack.com. Okay, let's get into the first video. So you guys, you probably know George Gammon. I know a lot of you in Telegram, you know George. I used to watch him much more than I do over the last couple of years, maybe last year. I think he's been doing content for about 3 or 4 years. And it's good. It's very educational. I think there's some stuff that's out public about his past and everything. I don't really get involved with that kind of stuff. I judge him for what he says. Even people that I disagree with vehemently, I still listen to what they have to say and pull out nuggets of truth, nuggets of wisdom out of what they say. That's very important, I think, to do. So anyway, I do watch George maybe every couple weeks. I'll catch one of his videos if it has a good title or if it's something big going on in the market. I want to get kind of his level of analysis, then I will watch one of his videos. But I was watching this, I think maybe this morning or last night or something, whenever this came out. Let's see, when did this come out? 22 hours ago. So I think it was this morning. But he's talking about Powell Pivot, okay? And he's also talking about the commercial real estate market and talking about recession and everything. And right here at the very beginning, it just caught my attention on how he characterized the pivot. So I want to go through that and then comment on it and then watch Powell, what the Powell pivot actually was. Okay, so let's go on this.
So the Fed just released this mysterious report. I don't know if you guys have heard this yet, but you've got to check this out. And I think this may explain why.
He's a great marketer. He's a much better marketer of his stuff than I am.
Jerome Powell just pivoted. And we've got to remember that is a big, big deal. Not only is it a 180-degree turn from higher for longer, higher for longer, higher for longer, then what? All of a sudden, oh yeah, sorry, we're going to go ahead and cut rates at a minimum of 3 times in 2024. That's a huge 180. But you've got to think about that through the lens of Jerome Powell from a standpoint of psychology. Look,
okay, so he said that there's a 180, a huge pivot. He went this way and now he's talking this way. Did that really happen? No. I'm going to watch Powell. I'm going to look at the dot plots. I'm going to show you guys that there was no Powell pivot, really. I'm going to look at the charts. And I'm going to say, look at where this supposedly happened. Did this change anything in the market? No. See, the thing about what these people are talking about, the Powell pivot, I mean, for one, it's a lot about clicks as well, but it's also about going, post hoc after the fact, finding something you were wrong about your prediction. And so you find something that then will square why it's behaving different than what you thought originally. So if you were like me and you're saying, okay, that we're really watching end of Q3 for some sort of market crisis, that didn't happen. So then we readjusted. We said, okay, well, before recession, these types of things usually happen. Stocks go up, bonds go up, or yields go down. People start going to safe haven type assets. And so that's exactly what happened. And then we can look at these things like CPI coming in October being a crazy month and causing a market reaction. Powell's pivot here supposedly causing a market reaction. So all of these things, they don't change the overall trajectory of what I have been talking about. But if you had the wrong prediction and you were like, okay, stocks will go down because the economy is going down and stock prices are based on earnings, and all that stuff, then you would have got this exactly wrong. And then you post hoc come in and say, oh, the pivot, this thing is so important. I can't stress this enough, guys, how important this Powell pivot is. That is the talk of people that didn't call it right originally, right? So before we go on, well, let's just hear some more about what he says about the psychology.
You're 67 years old, or however old he is. You know that this is your last hurrah, and this is how history is going to remember you. So do you want history to remember you as Arthur Burns or Paul Volcker? Easy question, right? But think about it.
So you guys, if you're watching my content, you probably know the difference here. Arthur Burns is the guy before Paul Volcker that let inflation, quote unquote inflation, and quote unquote let it get out of control and cut too early. And then you had a reacceleration. And then Volcker came in and had to raise rates to 18%. And he is seen as fixing the problem, causing a recession. The 1981, there was a little recession, and then there was a 1982 recession. So he caused those recessions to bring inflation back under control. And now he's seen in this mythology of the Fed as being, that is he will always be remembered for bringing inflation under control by causing a recession. He's like a hero figure. Or Arthur Burns, he's seen as kind of a clownish figure because he didn't get it right. Of course, the market, that's just the happenstance of the market. If the order would have been reversed, I don't think there would have been any difference. Burns would be remembered as doing what Volcker did. So the market is the one that's actually writing the history, and we are forming a narrative on top of that to explain things. But the market, is its own animal. So let's continue.
Again, put yourself in his shoes. If you create a recession, not that I don't want to give the Fed that much power, but let's just assume that that's how the market perceives it. So we have this huge hard landing that's similar to the .com or even like GFC type thing. You know that, yeah, you caused a lot of economic pain, but history is going to remember you like Paul Volcker. Or let's say another scenario would be that you bring down inflation and the recession isn't as severe. They're still going to remember you like Paul Volcker. So by tightening too much or by keeping it higher for longer, there is no downside for Jerome Powell. Absolutely no downside as far as how history is going to remember him. So you've got to ask yourself, understanding that, how bad would it have to be right now in order for Jerome Powell to pivot like he did the other day? To answer that.
All right. So he's saying there's no downside for Powell to crash the economy. Sure there is. Maybe not for his legacy, but as a human being, if you feel that you caused a recession, which, remember that line from The Big Short where Brad Pitt's character, and he says, for every percentage point and unemployment goes up, 10,000 people die or whatever it is. So does Powell want that on his conscience, that he crashed the economy and ruined people's lives and did all this other stuff? I mean, he was going back and forth with Elizabeth Warren just a few months ago, remember? And she was trying to say, you want 2 million people to be unemployed. And he's like, oh no, I don't want that. Nobody wants that. We think we can do this without raising the unemployment rate significantly, yada, yada. So no, I don't think that there is a difference to Powell, whether he crashes the economy and causes mayhem, or if he doesn't, if he tries to captain the ship to a soft landing. So I don't think that. Also, where is the analysis over 2019? So Powell has already given us, he's already had a cutting cycle. He came in 2018, took over for Yellen, said that monetary policy was on autopilot. I think he raised one more time, like in January of 2019. And right after December, he said it was on autopilot. In 2019, he hiked, and then that was it. That was the last hike. He took it off autopilot a month later. Then in July, he cut. September, he cut. October, he cut. Preemptively with the market. As the market was going down, yields were already below the Fed funds target, 10-year, 5-year, 2-year, all of those were below the Fed funds target. He sympathetically cut before recession. That is his MO, okay? That is his MO. I've talked about this since it happened, basically, at least since COVID hit. That is his MO, and when we go through this tightening cycle, he'll do the exact same thing again. And now it's looking like he's doing the exact same thing again. Why are people surprised? But let's keep listening a little bit more.
That question. Let's get right into this mysterious report. This is the infamous Beige Book. The Fed releases this 8 times a year, and they just came out with their recent report November 29th, which of course was before Jerome Powell came out the other day and made his announcement.
How many times do they meet? Do they have 9 meetings a year? Let me count that real quick. No, they have 8 meetings and 8 beige books. So they just have a beige book for each meeting, probably released, released about a month later, about 4 weeks later, it appears. So one beige book for every meeting. Where are we at? Okay, let's play.
So I think this could be playing a huge role in that decision-making process, or at the very least, it's something we got to consider. Now, I talked about this on the whiteboard video that's going to go live tonight, so you guys got to check that out. And Snyder was talking about this as well. So he was talking about this, about the Beige Book's recent reference to commercial real estate. So I'd highly suggest watching that video. But when I read...
Okay, so that's where I started watching Jeff's video, and we're going to watch that next. But let's keep going.
This report, it wasn't just commercial real estate that kind of jumped off the page at me. It was also unemployment, and it was the summaries from all of the local Federal Reserve banks, the 12 banks that make up that system. So let's go down into this report, and you'll see exactly what I'm referring to. So first, and let's just use their words so we can be as accurate as possible. Right here. What is the Beige Book? The Beige Book is a Federal Reserve System public economic conditions across the regional economic conditions and prospects based on a variety of mostly qualitative.
Just going to skip ahead if it'll play.
Directly from each district's sources. So basically, it's kind of boots on the ground intel from all these executive summary, the national summary, they call it.
Okay, here we go.
And just the overall economic activity, the very first thing in the very first sentence. On balance, economic activity slowed since the previous report. Now let's jump down one more paragraph. Labor markets. Now, you guys know.
Okay, why would that be a shocker? Let's go. to the FOMC website. This is their calendar, and you can go down here to the December meeting that they just had. Let's bring up the statement. And when I read this live with you guys, I talked about this line specifically. And it says here, recent indicators suggest that growth of the economic activity has slowed from its strong pace in the third quarter. And I stopped right there and I've said, that is a strong opening. That says something. I think the market reacted right away to that. You don't have to go much further than that first sentence of this FOMC statement. And it's interesting that the Beige Book, it did come out a couple weeks, I guess, before this, but it is saying the exact same thing. It opens with the exact same thing. So that should not surprise us. All right, let's go back to this one.
I know this from watching my videos, but for those of you who are new to the channel, the Fed hyper focuses on something called the Phillips curve. And this is this supposed inverse relationship between inflation and the unemployment rate. So as the unemployment rate goes down, inflation goes up. So if you want to bring inflation down, then you got to bring the unemployment rate up. But what's also interesting is if you look at unemployment.
So just about the formulas that they have for the economy. I talked about that a couple of live streams ago, and I likened it to dark matter. Dark matter, we've never been able to find it. We've never been able to observe it. It's just a remainder in a calculation that we gave the name dark matter to. And that's kind of like how the Fed works with the economy. The economy is infinitely complex, and they have a theory that it works this way. It doesn't work out. So they have to invent some crazy other variable that takes the place of that. So all of these equations are approximations, and they work in good times. So if the economy it's very boring and just kind of after a reflation, we have a period of say 2 years of just kind of calm seas in the economy, then these equations probably work pretty well, but they don't work when we're going into recession or we're coming out of recession really hard and all of that. So that's what I have to say about the calculations. Let's see when he starts talking about the individual. Well, he has some charts here, so let's go to these.
Let's check this out. So this is the unemployment rate, again, from the Fed's website, the Fred site. And anything really, you notice anything right off the bat here? Hopefully, you're looking at each one of these shaded lines, and you see that during or right before each one of these shaded lines going all the way back to 1950, this blue line starts to go up. And of course, this blue line represents what? The unemployment rate. And if you really look hard, you can see what it has done recently. It's gone up. So if you're Jerome Powell and you're hyper-focused on the Phillips curve, you're looking at this and you realize that every single time we go into a recession, hard landing, unemployment rate starts to notch up. Now, there are times when it notches up and we don't have a recession. But remember, we also don't have an inverted yield curve like we have right now. So show me a time here in the curve.
Okay, so that's, obviously looking at unemployment is highly correlated with recessions. We're obviously going into recession. You can see that without looking at the unemployment rate. I think this is unemployment rate's kind of a derivative of a derivative, so to speak. A very slow moving thing because I don't know if I mentioned this when we had gone live yet, or if I was just talking on Telegram, but oh crap, now I just lost my train of thought. Oh yes. So going into recession, you are not going to quit your job as readily because you might not get another job, and businesses will not hire people. They'll put it into savings instead of, or investments, businesses will, instead of hiring a new person or expanding their business. That then will trickle down to the aggregate in the economy, and that's like what you see here. So it's kind of a derivative of that, but it's not surprising. It's not surprising. We're obviously going into recession here. I don't know what his point is about showing this other than we're going into recession. Now, how big and bad are the recessions going to be? Another thing I noticed about this is in the 70s, you can see with the great inflation, higher unemployment in each successive wave, right? Then we had lower unemployment in each successive wave, starting in 81 and going to the great financial crisis. Then we hit another high. Who knows what it would have been in COVID without the response from the government? We were already going into recession. And it's very interesting too. If you kind of connect the bottom of 2020 to the bottom of when would that be, like 2022, 2023, it's almost a straight line, as if it's just a continuation. And now we're going into, really, this is a continuation of 2019. 2020 was an aberration. 2021, 2022, those were aberrations. Now we are locked back into where we were in 2019. That's what I would say. It kind of looks like that. Okay, but let's jump over to Jeff Schneider, and we're going to listen to the very first few seconds of this. And I'll share this tab. First few seconds of this, and then we're going to listen to what Jay Powell actually said.
Is this why the Fed is suddenly willing to accept lower rates? I mean, that's what publicizing the Fed pivot was all about, and I don't think it was an accident. They have been fighting against rates, trying to get them to go higher all year, really since last year. They've been talking higher for longer, rate hikes, inflation risk, all this while. And then suddenly, between December 1st, when Jay Powell says it's premature to talk about rate cuts, and December 13th, where he has his press conference where he says, yes, we're talking about rate cuts, something seems to have changed. Now, there's a couple different reasons. Another one is...
Okay, yes, we're talking about rate cuts. All right, both of these guys are making it sound like Powell did a hard pivot, like, stood up at the podium and was like, people, we're talking about rate cuts now. Like, very explicitly saying it. I want you to listen to this question and answer here. And he doesn't say even anything about talking about rate cuts until the very last second, just by a slip of the mouth, like a slip of his tongue. Okay, but let's listen.
Steve Leisman.
Yep.
Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is, really how high to raise the policy rate. And that's really a question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. There's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this: we are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature. And we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view. And is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Boom, that's the pivot. That was the pivot right there. Starts to come into view. We're talking about when it will be appropriate to start dialing back. Obviously, that's a topic of discussion out there in the world, and it was a topic of discussion for us. I mean, he had some prepared response, but it wasn't word for word. He was kind of shooting from the hip, going off the cuff. And the market immediately said, oh my gosh, this is a big pivot. This is a pivot. They're thinking about cuts. Look at their dot plots. Their dot plots are showing 3 cuts next year. Let's take a look at the dot plots. So go back here to the calendar, and we can look at their implementation note in PDF version. And we're going to go down here to the dot plot. Zoom in here a little bit. You see that was their last meeting for 2023. So this was a straight line. And they're showing cuts next year. Okay. Not all of them. A couple of these guys are showing no cuts for next year. But what is the average of this 2024 forecast? Well, they have that here as well. Right here. So the median Fed funds rate in 2024 is 4.6. So from 5.25, that would be 3 cuts, right? So because that range would be 4.5 to 4.75, that would be 3, either 175 basis point cut or 3 25 basis point cuts to get down to this 4.6. And everyone's like, oh my God, the 3 cuts, not just 1 or 2, but 3 cuts in 2024. Oh my goodness. Well, let's go back to some of their other dot plots. So September was the last one. And we can go back. Let's take a first look at this, the actual dots. And I mean, it doesn't look all that different here. More than half of people thought there was going to be one more hike. And then there was one person, crazy person, that thought they were going to get up to above 6% in 2024. But most of them were down here below, showing cuts in 2024. And let's take a look at what the average would be. 5.1. Okay, 5.1. And this is from the September meeting. And that would be 1 rate cut. So even going back into September, they're talking about 1 rate cut. All right. Now let's go back another release of their economic projections. This is from the June meeting, so 6 months ago. And let's take a look at this. Let's take a look at their dot plot first. So back then, it looked like most people thought there was going to be one more hike. And I'll note at this time, at the June meeting, I think they raised in July. But in June, it was 5 to 5.25. So they've hiked once since this report came out. But you can see most of them thought they were going to be above 5.5 to 5.75 roughly by the end of the year back in June. But look at 2024. 2024, the average is much lower. It was lower than where it currently was at 5%. Now let's take a look at exactly where that average was. 4.6. The same exact number as the median dot plot for this last meeting. That's what they had back in June. We knew this was coming, people. This was not a surprise that, oh my gosh, Powell, he said they're talking about when they're going to start cutting. It was an offhanded remark at the end of a question that he was talking off the cuff, and he said that, and it's already been in the dot plots. I didn't look at the previous one, but let's go back one more dot plot. Oh, that's June. Oops. Let's look at the March dot plot. And we'll blow this up a little bit. So you can see the March dot plot also had it sloping down. Cuts in 2024, cuts in 2025. Why is this surprising to people? Why is this all of a sudden big news? Well, because the market's shifted. Let's go to a live chart. Let's go check out some charts, guys. Okay. share this tab. All right, there we go. Live chart. Let's go to the US 10-year. And let's see, what date was that? The 14th. So this is where the Powell meeting was, or the FOMC meeting. Right here. It had already come down from October 23rd. It had come all the way down here. And then this last 12 basis points is blamed on Powell's pivot. Does that look like a Powell pivot had anything to do with this? No. I think this is bottoming, by the way. Let's bring in the moving averages here. This is the 50 and the 200 day. You can see pretty much Powell said pivoted right at the 200 day, and it fell from there. Almost looked like it lost support, right? And it fell down. It's having a little rally here today. But what happens when we add in the 365 day moving average? Look at that, guys. Look at that touch. That touched, it missed it by, it went over by just maybe 1/10 of a basis point or something. It's crazy. It bounced right off the 1-year moving average. And now is rallying. Also, if we take a look at some of the oscillators and things, we have the RSI oversold, ready to go higher. It can't go much lower before it cools off. Before it goes sideways for a while and this drifts higher, the RSI, then it can come back down, right? But this move is pretty much over for the US 10-year. Also, the MACD is been negative for a long time. Thought it might cross there, but it's ready to cross. If this crosses up, we could see the 10-year rally slightly. And how does that go into all the people's comments about the Powell pivot? I'm thinking we at least test the 200-day moving average again up here at 4%. Maybe more. Maybe we try to test the 50-day moving average as it's coming down. And what's going to happen when we're going up like this? Everybody's going to say reacceleration, soft landing. CPI is going to go screaming higher, blah, 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 blah. Not going to happen. Nothing falls in a straight line. Okay. We're going into recession. That is where we're headed. Everything else is noise. That's why on last Friday's, which one was it? Last Friday's Pro newsletter. Let me bring that up. Where was that? I said, it's all noise around the recession signal. I say, block out the noise. There's so much noise out there. This week is a perfect example. It seems like every month there's talking heads, blah, blah, blah. But we're going into recession. That's where we're going. So block out all the noise. Okay, let's go back to the charts and see if we can find anything else out. Let's take a look at oil. There is some oil stories happening right now with Angola dropping out of OPEC, but we will see. I drew this blue line a couple days ago on the live stream. I thought we could rally up here because we had this death cross happening, and we tend to rally into a death cross and fall into a golden cross. And that kind of happened. We had a few days here of positive, but now it's turning back over due to this Angola news. I don't think that's going to stick, honestly. But maybe we'll cover that on another live stream. So this is oil. Oil's, how can anyone look at this and be like, there's robust demand out there? Oil is at $73 a barrel. Let's take a look at gasoline. Gasoline futures. Same thing, right about $2.15 for gasoline futures. But if you zoom out and look at this on a long-term time scale, this is back when those people like Luke Groman and others were hollering about, $200 a barrel oil. You had Zoltan Pozar still in the headlines for some, God knows why, talking about commodity future. No, the commodity future is not coming. Let's take a look at it. Or a big commodity bubble is not coming. This is the Goldman Sachs Commodity Index. And I actually put this on the BM Pro this month or this week. You can see that it's coming down too. It's just like oil. It's heavily dependent on oil. But it's coming down as well. If you zoom out to a month, let's go to monthly candles. And I've talked about this a lot. So all this high in quote unquote inflation that we've supposedly had, the commodity index did not reach the highs from 2008. Even with the high CPI and war with Russia and sanctions and all of that, we did not get to the peak in 2008. How is that possible, people? I'll tell you how. Because we're in a deflationary era. You can draw, let's see, a parallel channel. We can go like this. Basically, this is the channel, okay? The death of the system. That is the death of the system. A slow grind to nothing. This also matches with demographics. It matches with the end of a credit bubble. It matches with deglobalization. It matches with everything. The commodities are not going into a bubble. They are grinding lower. We might get these temporary spikes like this. Russia caused this one. The war in the Middle East didn't even register. This Houthi thing is not even registering. Demand is going down. We're grinding down in a deflationary environment, in the end of a credit super cycle. Now we can apply that back to the 10-year. Let's go back to the 10-year. And let's go to the weekly. And I'll get rid of this red arrow. So this up here caused too much trouble. It caused too much pain. Could not be sustained. We're going down. What happens in a recession? Yields fall. Okay? Yields are going to fall. They're going to fall rapidly, I think. Like I said, we could have a week or two where they rally, and then everyone's going to be like, oh my God, get short on bonds. We have a reacceleration. Then we're going to top out and we're going to crash and we're going to trap all those people. The market has a way of squeezing the most, wrecking you the hardest possible. So I can see that. I can see a rally to trap people and then a continued crash into the end of Q1 in an exact replay that we had back here in March. Remember that big banking crisis last March? That caused the 10-year to drop 20%. So far, we have dropped, oh, that's the arrow. So far, we've dropped over 20% and no banking crisis. I don't know. Okay, that's all I have to say about that. Let's go back to Jeff Schneider. I really like his content. Like I told my guys on Telegram, he is one that kind of woke me up a little bit, caused me to see things differently. When he said, oh, the central bank is not central. The central bank is not central. I didn't believe it. I remember specifically, I was living in my old house in the Midwest, cutting grass, and I was listening to a podcast that I don't listen to because I can't stand the host anymore, Macro Voices. And Jeff was on there, and Jeff is saying central banks are not central. The dollar's going to get stronger, blah, 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 blah. I was so triggered. I had to prove him wrong. And over like the next 6 months, the dollar got stronger. I was completely wrong. And I had to change my assumptions about how the system works. How does this apply to Bitcoin? Before we don't say anything about Bitcoin. Bitcoin is a deflation hedge, just like it's an inflation hedge. It's a safe haven. It's a pristine safe haven. It's a safe haven that you can take custody of. You can send anywhere in the world in 10 minutes, unlike gold that you have to have in a vault and you have to have counterparty risk with it being in someone else's vault in an allocated account and stuff. Bitcoin doesn't have to have that risk. You can also, I guess, I mean, there would be the same sort of regulations about taxation and moving money around the world like that, but it is the pristine safe haven. And it's in its own cycle. It's going up right now when the rest of the economy is crashing. It's going up in a halving cycle with an ETF coming, and it's pristine safe haven, a deflation hedge. I don't understand how people couldn't see that, wake up and buy it. I could see if people are thinking like in 2018, we had globally synchronized growth. There was no reason to look for a safe haven really at that time because people were convinced that the economy was booming. The global economy was booming. Rates were low. Things were going fine. But now there is more emphasis to get into Bitcoin right now. But okay, let's continue with Jeff Schneider and see what he has to say.
Is the macroeconomy, where the U.S. seems to be doing okay, but we all know there are greater risks to doing okay. The soft landing might not actually come in as everyone is hoping. Greater risk to the soft landing, maybe contacts within individual Fed districts. People are talking about the economy being weak.
Okay, so how long has the 10-year been below the Fed funds? Since November, over a year. And now it's falling away. And I've said that the Fed is going to follow. Powell's MO is to pivot early. On one of my newsletters, I said that I would not be surprised with the first cut in January. Or no, I said a first cut in January is possible. It's priced in by March already. So, excuse me, Powell's MO to pivot early and be sympathetic to what's going on and try to front run any sort of economic contagion. That's what they're doing. I mean, they're massaging all sorts of parts of the financial system with their term loan funding program, with their reverse repo, with, obviously they have the discount window. The Treasury is standing up that Operation Twist of their own, where they're going to buy longer term bonds and issue more bills, right? And so they have this Operation Twist going on. They're massaging every part of the market that they can see right now. Yet yields are still falling. People are still fleeing to safety. I think a cut in January is a possibility, a much higher possibility than most people think. Okay, let's continue.
Weaker than is actually showing up in the macroeconomic accounts that are still looking backwards. That's a possibility. Another possibility, maybe it's a more prominent one, and it would certainly help explain the sudden urgency here. I'm talking, of course, about commercial real estate. It's a problem. We all know it's a problem. We all know it's going to continue to be a problem, but we have to wonder if maybe it has finally reached somewhat of a breaking point or the initial inflection point toward getting more and more out of control. Because up until this point, it's been sort of like stasis. It's stabilized. It's steady, not in good shape. Let me start with a quote from Green Street, who just a couple weeks ago mentioned something that I think fit in with the evidence and the clues that we're trying to put together here. This was December 6th. The rise in bond yields that occurred in September and October essentially froze the transaction market. The good news is that bonds have staged an epic rally since, and commercial property is now fairly valued versus corporate bonds. Property pricing may well have hit bottom. So from the Federal Reserve's perspective, like it was doing, and there's lots of evidence for it, we'll go over some of that in just a moment. But essentially, the commercial real estate market frozen, that raises the risk of distressed sales going into a frozen market, which would produce the worst outcomes. Everybody's just kind of sitting back, waiting and hoping everything works out just fine. But there's no chance of that happening if, as lending dries up, as there's an inability to roll over.
Wait, who was the author of that he just showed? This one. Oh, I thought it said Stephanie Kelton, the one MMT chick.
As there's an inability to roll over funding, and that forces more and more current distressed borrowers into just selling their properties, but there's no market to sell it into. Suddenly, prices don't just go down. They go down in fire sale fashion, which triggers more and more sales, distressed sales, because those who are waiting on the sidelines, just hoping everything works out, if you start seeing distressed sales come in, you no longer have the luxury of waiting. It just unleashes the tidal wave of all of the worst type of behaviors that we associate with a genuine real estate property banking crisis. So given what Green Street said about interest rates, maybe the only hope to unthaw the market before the sales start to come in would be lower rates. And it might not be enough, and it might be more of a Hail Mary type from the Federal Reserve.
Okay, the Fed does not control rates. Obviously, you can see here, I mean, just look at the 10-year, this in black. The Fed doesn't control these rates. The 10-year is the one that's very highly correlated with mortgages. Actually, let's go back to the chart and let's take a look at the mortgage rate. Okay, mortgage rate is coming down. And I drew this arrow. I can't remember if I did that on a live stream or for some newsletter that I did, but this was interesting. Okay, so all the way December 2021. So 2 years ago, mortgage rates were down at 3%. Then in 10 months, they got to 7.3. October of 2022, remember, end of Q3, there is seasonality built into financial markets. And Q3 is very important. Why is that? Well, it's because of, this one. Okay, where was this? Sorry, guys, I'm looking for a post that I had. It's this one. Okay, so this is an example of the Bitcoin and markets protons that I do. This was just number 4. So I went from doing a pro, which was a more extended. The protons have become more and more extended too, but these are supposed to be short and sweet. I did make this public back on September 28th. That was when I wrote it, but it was made public on October, I think that's October 11th. It might be November 10th, but October 11th. And I talk about climax in markets, okay? And I was using that term. I mean, George Gammon is a much better marketer than I am, but I thought like climax in markets, that would be some sort of catchy thing that people might pay attention to, but they didn't. But okay, that happened to be pretty close to the top of these markets too. So the 10-year was going parabolic. It still had another bit to go here, another leg up for another month. So this was September 28th. It continued to go up for another month, but this was fairly close to a blow off top. It's going parabolic, blow off top soon. It was 1 month later. WTI talked about the exact time the oil was going to pivot right here at this retracement, and that is exactly what happened. Talked about 10-year peaks long before recession. You can see back in 87, 99, 2006-ish, 2019, and we're going to do the same thing here. That's what we're looking at. Stock market goes up before recession. See this? The .com was unique because I haven't studied .com very much, but um, it was stock market centric, right? And so stock market went down way before, maybe 6 months before the actual recession, official recession. But you could say the official recession started a quarter early, and then we would still be in the exact same ballpark as all these other ones. 2008, same thing, goes up to just about a month before, and then it falls into the recession. 2020, the same thing. And I predicted that we'd do the same thing going into recession next year. Stock market goes up into recessions. Okay, now this is what I want to talk about, the seasonality here. So all of these moves in major markets are corresponding with the end of Q3. This seasonality is very important because most major market crises happen around the end of Q3, with the end of Q1 coming in second most important seasonally. So yeah, they're like the banking crisis this year that happened in March. COVID happened in March. There are some other, I'd have to go back and look, but there are some other like stock market crashes that would happen in March, but most of them happen in September or October. I think if we stripped out all of the seasonal adjustments in almost every metric, we'd get a better idea of what real seasonality looks like. It is very powerful. I mean, it's so powerful that it happens every time September, October, or very consistently in September, October. If we stripped out all the seasonal adjustments, we would probably get a better idea of this power of the seasonality. That's why, like right now, sitting in December, I'm not really worried about any sort of market crash or major shift, trend change or anything until getting into maybe end of February, early March. That's when we're going to get a possibility for a trend to change and some acute stress to be felt and a possibility of some sort of crash in March going into April, end of Q1. But the big red flag, the big thing you always want to look at is end of Q3. But why is this seasonality like this? In banking, there's well-known seasonality to interest rates and loans. December through February activity is typically at its lowest. Okay. It ramps up through the spring and summer and tends to climax each year in August or September. That being the case, quarterly reports due by banks to the SEC or other agencies would also culminate around the end of Q3. And remember, Q3 is the government's fiscal year as well. So the effect of the government's fiscal year is also huge. It runs from 1 October to 30 September. I remember in the military, we submitted our dream spending items in September because units would try to use all their money before October 1st. Government spending is a significant portion of the economy and is getting bigger all the time. Government contractors would orient their fiscal year around the government's probably. Lastly, the good old agriculture cycle. Obviously, the agricultural sector is going to be oriented around a fiscal year oriented around harvest seasons or seasonal harvests. Those come at the end of summer or end of Q3, surprisingly. Trading in futures and options would therefore target those dates for delivery. And if you're a farm and you're taking out a big loan at the beginning of the season to plant your field, fertilize your field, irrigate your field, and oh my God, we have a weather event and I lose my crop this year, either a late frost or early frost, we have a big hailstorm that destroys everything, whatever the case, those things are going to be settled up at harvest time, right? Which happens to be close to the end of Q3. So there's going to be insurance payouts. There's going to be paying back of loans, defaults, etc. Those are, there might not be as big as, say, the financial sector or anything, but they do have an effect that is overall adds on to the effect of all these other seasonal adjustments. So anyway, why did I get on that? I think I was talking about from Jeff Schneider. And okay, let's listen to some more what he has to say.
perspective, that would make a lot of sense about why maybe the Fed changed its mind. No, it's premature to talk about rate cuts to all of a sudden, yeah, we're okay with rate cuts. We're okay with rates going down. We're not even going to try to talk the market back higher. These are the kinds of investigations that we go over at Eurodollar University, especially in the deep dive analysis. And right now we're having a Christmas sale at Eurodollar University. You can get a bundle of deals there. As far as the Fed perhaps discussing the commercial real estate situation, we do have some evidence for that too. It's not perfect evidence, not absolutely clear and unambiguous.
Oh, what I was trying to build up to this. So the sluice data. Commercial real estate. I mean, obviously people have been talking about this for a long time. For more than a year, probably, people have been saying, oh my gosh, the commercial real estate is going to crash these banks. You know, it's going to cause all of these bankruptcies and defaults and everything. People have been talking about it for a long time. And if we go to the sluice data, which I have showed here, read through on the live stream before, let's excuse me, let's go back to January and see where it was at. This is January of 2023. And let's do chart PDF. All right. So it had not yet turned over, but it was coming off a deep pullback in 2021. And 2022 actually had a surge in small loans. Okay. So that had not fallen yet. These are tightening standards. Okay. So I have it backwards. Net percent of domestic respondents tightening standards for commercial and industrial loans. This means that about 50%, 40 to 50% of these senior loan officers were reporting that they were tightening standards in January already. Let's go to, there's real estate. Commercial real estate. Tightening standards in commercial real estate, up to 60% of senior loan officers. And we have it broken down here by multifamily. They'll talk about that. Multifamily, same thing with all of these. Construction and land development, non-farm residential, all commercial real estate loans in black. But this is even worse than the commercial industrial. Sorry, I got something here. All right, so that's even worse than plain Jane commercial and industrial loans. The commercial real estate loans were tightening dramatically. And now how about demand? So it's not, I often talk about why rates fall and why rates rise. And this goes back to Milton Friedman's interest rate fallacy. Milton Friedman's interest rate fallacy says that rates rise because money is loose, the economy is booming, people can afford higher yields, there's demand. They go out there and say, yes, I can make 10% on this new business venture, so I will pay 6-7% on the loan for it or whatever. I can make 20-25%, whatever the case is. And so that's why rates rise. Rates fall because you can't do that. You don't want to take out a loan because you can't make any money anywhere. And the banks see that, hey, these people can't make any money. We're going to tighten our standards because we see more risk. So we're going to tighten our standards and demand falls. That's what you should expect in these types of environments. So demand here, already in January, demand was through the floor too. This is reporting stronger demand for commercial real estate. Bam, negative 60% of senior loan officers already in January said that they were seeing low demand and they were tightening their standards dramatically. Not this nice and smooth like we saw in 2011 through 2017, kind of dilly-dallying around, a little bit tighter, a little bit less demand into 2019. No, this is whoosh, 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 whiplash, baby. Now let's go to the most recent one. And we've talked about this on the show. This is not a surprise that commercial real estate is having problems. So here we go. Let's zoom in. I mean, if we go back and look, that January was right here about 40 or 50 for tightening standards. They tightened them even more because from one survey to the next, it's, did you tighten? It's like the PMI where 50 is neutral, but it's compared to the last reading. So if you're at 51 2 months in a row, it's not flat. You slightly expanded 2 months in a row. The 50 is now the 51 from last month. If you're at 46, the next month, that 46 is going to reset to 50. Now, where did you go? Oh, you went back down to 46 again. So you're continuing to fall. All right. That's similar to this, that each month has to reset to zero. So the people that had tightened at 50% by January, they continued to tighten. They continued to tighten, and more of them tightened. It's not cumulative that 60% are tightening. No, that 60% are tightening more than they tightened last survey. Look at that. I mean, it's obvious when you look at this, there's going to be a problem with commercial real estate. And, Powell sees this, that everyone sees this. Demand, same thing, continued to fall, almost down to 80%. No demand. Crazy. Okay, let's go back to Jeff.
But back at the end of November, the Fed put out its beige book, and there were a couple anecdotes sprinkled in, as you would expect, because that's what the beige book is, a collection of anecdotes. And some of them were suggesting that maybe there is a growing problem in commercial real estate. And not that it's a surprise. It would be not a surprise if it accelerated, but we're looking for the possibility that it has, or that it might, the chances of it accelerating to the downside and deteriorating have gone up. And what the Fed said in the beige book was mostly...
So anyway, just continuing on from that sluice data, the commercial real estate market deteriorated rapidly, but people held on. People wouldn't sell. They extended as long as they could. They held on all year from January or even before to December. And we talked about this in residential real estate as well, where people were doing some creative loans where the builder would actually put some of the down payment up or something like that and make it so that the price that you paid for the house was actually lower, but the market price that it sold for remained the same. So prices actually fell, but what the selling price was remained up, strong. So people were doing a lot of creative things in residential and in commercial real estate just to extend and pretend. And what Jeff is talking about here is that has ended. They cannot extend and hold out any longer. They're going to have to start selling.
Yeah, there's issues with commercial real estate. It's kind of hanging in there, but we're still looking, we're still monitoring. But a few of the districts were a little more forthright in their concerns. One of them being Dallas. The Dallas Fed said this in the beige book: activity in commercial real estate softened. Apartment leasing slowed and rents were flat to down. Office leasing remained minimal. Vacancy rates were high and concessions remained generous, with new supply outpacing demand. Industrial vacancy rates ticked up and rent growth cooled. Heightened macroeconomic uncertainty, high capital costs, and diminished appetite to lend, there it is, continue to deter investment across property types. So again...
Okay, another thing too is I wrote down here linear, that a lot of these problems, especially with George Gammon, when he talks about these things, they talk about it in a linear fashion. Okay, the market knew this was occurring. It's not like this is out of the blue. Okay, the market knew this was coming. It's not going to be a linear move. Just like we're waiting kind of for the bottom to drop out gradually, then suddenly, it's going to be the other way too. People are going to suddenly realize it, and it's going to suddenly switch directions on them. Just like I said, the 10 year is probably going to creep up a little bit. People are going to say, oh my gosh, reacceleration, and then it's going to fall down again. So these things don't happen in a linear fashion, and the market knows what's going on. We see the 10 year coming down. We see mortgage rates coming down. The Fed really doesn't, I don't know why Jeff is painting this as a Fed thing. He's the one that taught me the Fed is not central, or the central banks aren't central. And now this is all about the Powell pivot.
The same generalized macroeconomic weakness leading issues in commercial real estate, pretty much all types, plus that issue about lending. That's all in the background here. And then Chicago went a little bit further. Business loan demand decreased modestly, and loan quality was also down, with contacts highlighting struggles in the commercial real estate sector. So a little bit further along with struggles in the commercial real estate sector, conversations between the Chicago Fed staff and its leadership and those inside the district, and Chicago being a pretty important district, financial district especially. So there's another one. But Atlanta, the Atlanta Fed, they're the ones that went the furthest to highlight what really seems to be more than a just generic macroeconomic uncertainty or just struggles. Commercial real estate contacts reported diminishing conditions across the sector. In addition to the office segment, high-end multifamily and industrial real estate were noted areas of distress. Contacts reported concerns regarding financing as most lenders increased underwriting standards and reduced funding commitments. A growing wave of CRE loan maturities and declining asset values are significant downside risks to the CRE outlook. And that's basically the biggest fear here. Because if we have a frozen CRE market as all of these loans come due and lenders are not lending, those who have borrowed money for these properties that have gone down in value have no choice but to sell. And if there's no market for them to sell into, prices have to absolutely plummet. And then that can trigger the tidal wave of distressed fire sales. And that's what we're trying to avoid here. Certainly that's something that's going to be right on the top of the mind of FOMC officials who do not want to see that spread into another banking crisis. The best chance, it might not even be a good one, for the real estate market, commercial real estate market to unthaw would be with lower rates, some accommodation, as the Federal Reserve might call it. It's not actually that, but
Not lower rates from the Fed, lower market rates. The 10 years coming down. So, yeah, Jeff is saying that the Fed is central here, but they're not. The Fed is not central. The Fed will follow exactly what the market is leading them into.
But in this case, they're hoping that lower rates might unthaw the market. We do have some data that shows that commercial real estate lending has frozen, just like as has been reported here. From the Federal Reserve's own statistics, the HA commercial banking data, you look at the commercial real estate lending, what you see is that right after August 23rd, right as the September effect in the bond market, the sell-off, rising interest rates really started to get going into September, commercial real estate lending didn't crash, didn't fall, but it flattened out, which again, that's consistent with everything we're hearing about a frozen real estate or commercial real estate market. I also see a modest increase in commercial real estate since the week of October 25th. So that's as rates are going down, there's been a little bit more commercial real estate loan volumes going into the system. So like Green Street had said, there is some basis to think that maybe rates going up, that was bad, rates coming down, there's some hope. And the Fed might just grab onto that hope before it gets to that breaking point situation. Now, the Atlanta Fed mentioned high-end multifamily real estate loans, and that's where a lot of the distress actually seems.
Okay. I think we talked enough about that. Let's go switch gears back into Bitcoin. Being Bitcoin and markets. That was enough market talk. You guys know my position. We're going into recession, and the market will lead the way. So let's go to the daily here. Logarithmic. Open this up. So I pointed out this level, 44,193. That's the high close from back here on December 8th. I also talked about support at 40. I thought that we were going to find support at 40, even if it had gone up higher. So where's path? If it had gone up like this to 50, say, then corrected, I thought it would correct to 40. If it, wherever from here up down to 40. 40 just seemed to be a really good marker, as well as even if we went something crazy like up to 60,000, 40 would be a 33% retracement. That seemed to be legit. So I kind of called this out to the pro members, and 40,000 was the support that I was looking at, and it seemed to have held. We'll see. I'm not ready to say that we'll never go under 40 again, like I have for 30,000. But pretty soon, I mean, if we break out of this, I think we can confidently start saying we're never going below 40,000 again. So testing this level, and we'll see where we go from there. Let's take a look at the mempool, because this is starting to cause some concern from people, rightly so. Mempool.space, you can see that we are all the way up at 365 megabytes in the mempool. Most of the increase has come from this section, which is 20 to 30 sats per virtual byte. Let's take a look at ordinals, because a lot of people were I think this is this the page. So here's the ordinal dashboard on dune.com, and there was a jump in activity here over the last week. Let's go down here. But they are paying extremely high fees. You can see that pretty much all of them are paying over 100 sats per virtual byte. Fees spent, you can see they're just pumping out. They're paying a lot to miners right now. Last week, there was a total of $28 million spent to pump out these inscriptions. And this week so far, it's 21 million. And there's still Friday and Saturday to go. So that is a whole lot spent at very high fees. If we go down here, let's see what they mainly are. They mainly are these BRC20 mints. So that's not good, because those are like the most inefficient way to mint things, I guess. 1.5 million out of the total of what? About 1.6 million. Going down here more. I wanted to go to this one here. BRC20 operations. So you can see that orange is mint and gray is transfer. So in my mind, transfer is trading them. And there's like very little, about a tenth of it right now is from trading versus just minting. But then I saw some other people talking about that there has been $50 million, what is it, per day traded on these NFT marketplaces for Bitcoin NFTs. And Ethereum's down at like 11, and Solana is like at 8 million per day. And so Bitcoin's blowing both of those out of the water combined. But I don't see that in the data. So I don't know how they're counting that. If you guys know, I would love to hear how they're counting this, how they're trading these when there's like no transfer volume versus mint volume. And of course, a lot of people are worried about this. I saw David Bailey of BTC Media. He was saying that, fees are going to continue to go higher. And when Bitcoin goes up, fees will be like $2,000 per transaction. I don't think so. Inscriptions won't be profitable at that point. You know, if it costs you $30 million a week to do these type of things with these high fees, it has to pay for itself, you know. And if it doesn't pay for itself, you're not going to do it. You're not just going to burn money indefinitely. So I really don't think that the fees are going to go that high. Also, that does mean that people are willing to pay the fees. So it's like saying nobody goes to that restaurant anymore. It's too crowded. It's obviously wrong. Fees are not too high because people are willing to pay the fees. So if it's at 2,000, someone's willing to pay the fees. And that price is so many transactions out that I don't think that's sustainable. I think it's sustainable to have $50 fees for the long term, maybe 100. And I'm talking for the next 2, 3, 4 cycles. Maybe in 20 years, we could start, fees of $1,000 per transaction, roughly, whatever that comes out to be in sats per virtual byte. But, that's long term. And that also brings up the question that how are these layer twos going to evolve? What happens if Bailey's right? And right now, we jump to $200,000 with this ETF launching in the halving. In the next 6 months, we get to 200,000. Fees are 2,000. How is layer 2 going to handle that? How is layer 2 going to evolve? Nobody's going to be able to afford on-chain. People in El Salvador are not going to be using on-chain transactions. They're not even going to be using Lightning, because Lightning depends on the decentralization of Lightning. The whole selling point depends on you being able to run a node, you being able to manage your own channels with your node. But if there's $2,000 fees, you're not going to be able to do that. Lightning with $2,000 fees is uneconomic, period, dot. End of story. Lightning is dead if fees are $2,000. There's got to be another layer 2. Side chains, people. Side chains. I think that's going to become huge. Most people will not own on-chain Bitcoin. Most people will be in, they might own on sidechain Bitcoin, like LBTC in a wallet or whatever other sidechain they're having that's pegged, and you can cryptographically prove the peg. So it's like having the monetary unit. It's like using Bitcoin, but with a peg that's cryptographically provable. That's what's going to happen. That's the layer 2, guys. That's what it's starting to come into focus a little bit for me now. And I think that can happen within this next cycle. So in the next 4 years, I think we will start seeing a lot more use of sidechains, because Lightning, it's great. It's wonderful. It is an honorable path to follow and build and use. But at $2,000 fees, it's not going to happen. It's not usable. Okay. That's it. Let's go back to price chart one more time before I wrap up here. So we're sitting at 43,500. Again, 44,193 is what we have to break and close above for this to happen. I mean, we could be looking at this situation down here. Remember, we were talking about this for a long time, and we just triangled right up like this. And that happened to be in the channel, right? We were in this channel going up, and we kind of hit this top, and it took us a long time to close above that line. We were watching that on Telegram daily, saying, oh, is it going to break now? Is it going to break now? And then when it did break on December 1st, we went straight up. We could be doing something like that now. Or, I mean, Bitcoin loves the triangle, guys. It really does. I would not be surprised if we're looking at something like this, going out to the D-Day for ETFs. Just a thought. Okay, let me take a look at the comments, see if there's any comments. I probably should be checking those throughout the entire thing. I would love to have a co-host on here. Let me check on Telegram. Nothing on Telegram. Let me check the chat here on the live streams. Dex Invictus back with us, of course. What's up, buddy? Afternoon to you. Happy Thursday. Almost there. I probably will be live streaming tomorrow or doing some work tomorrow, but then starting on Saturday, I'm going to be taking out. I probably won't put out a newsletter on Monday either. Maybe push that a day, because Christmas is on Sunday, right? Let me just check. No, Christmas is Monday, so I will not be putting out a newsletter on Monday. I might just skip this week and start all fresh on the first of the year, with the next newsletter issue. I will be doing Pro one, I guess, tomorrow, and then writing for Bitcoin Magazine next week as well, Wednesday, Thursday, and then start with the newsletter then on Monday. So, all right. So, see 9 people watching there on YouTube and Rumble. If you have any questions, you can put it in the chat. Same with Telegram. Checking out the chat here. Going once. Going twice. All right, well, that's going to do it, guys. Thanks for hanging out, and I'll see you on the next one. Bye.